Hey, good morning, everyone. Welcome to the Ankerstar Wealth Morning Show. Just me this morning, and just a quick show for you because markets are in the red. We're going to talk about why the markets are in the red today. That'll be the first topic, and then secondly, I do need to get this out there. I've been searched for a CPA to actually refer folks to. I finally have one, so I'm very excited about that. But I want to make that known to you that if you need a CPA or would like to at least start the conversation with a CPA, reach out. And we'll be able to give you that referral and hook you guys up. Same thing on the last topic will be the estate lawyer side. Really have two that I work with. One specializes in wills, the other specializes in trusts. And we'll get more into that here in a second. Before we get started, this financial education presentation, you have to do your own due diligence before acting upon anything you hear in this presentation. More disclaimer information is available at ankerstarwealth.com, and the opinions expressed this morning are mine and mine alone. Sharon. Yeah, pretty big sell-off today. So NASDAQ down 2.9%, so tech really taking a hit after yesterday's sell-off too. So when you put these back to back, I mean, you're looking at a 5% move in a couple of days. So really a pretty significant event in the market after what I would say is largely a quiet year. So that our narrative changed. We stayed long and strong, saying there was not going to be a recession. We stayed strong for the first 6 months. If you listen to our July 3rd investment advisory board meeting, we talked about de-risking portfolios. That's why you've started to see a little more USFR, VCLT, buffer, BUFR in your portfolios to start to tone down that risk in anticipation of volatility. Well, like anything else, it'd be nice if volatility slowly crept in. It didn't. It just basically, boom, here we are. A couple things that are kind of pointing towards that recession now. First one is the jobs number this morning. Jobs number came in pretty light. Nobody, most people don't really use the hard jobs number unless you're an economist. But the big, what retail facing number, if you will, is unemployment went from 4.1% to 4.3%. So if you remember way back to the story of two nevers, right? We've never had a recession with unemployment below 4%, and we've never raised interest rates as much as we did in 2022 without having a recession. Well, now that unemployment's above 4%, then we are kind of what I would call ripe on the employment side for a recession. So really, this has been a fast moving ball game. So I think the forecast, we had a working group yesterday where we talked about the indicators out there with household debt, and a lot of the things that can kind of point in this direction is that we probably are headed to a recession. And it's hard to time those things. Remember, to actually have the recession, it's 2 quarters of negative GDP growth. So really, you've been in the recession for 6 months before you even call it a recession. So it'll be kind of interesting to see how this plays out, but not nearly as optimistic as I was even a month ago. So those are the things we're taking a look at here on the home front with your portfolios. The jobs number is only really one indication. The earnings are all important for the different companies that we hold, and Apple crushed earnings, but the big one out there is Amazon did not, right? So Amazon misses. They're off 10 to 11. They were down 12% at one point in time today, which is a huge deal for the company itself, of course, and the fact that it's one of our top 5 holdings. That aside, though, it's really an insight into the consumer, right? Amazon has made so much money off of all of us from everything they bring to our doorstep. From they were one of the primary companies we invested in coming out of COVID, because we can't go outside, but yet Amazon can deliver all my stuff to my door still. It's like, well, that's pretty impressive. Need to put some money behind that company. So great company. I'm not worried about the company at all, but certainly their numbers are waffled over the past quarter, and again that second quarter. So again, these look in the rearview mirror a little bit. So things could actually be a bit uglier out there than I think the Fed has anticipated. So again, they chose not to drop rates. I think the news from the jobs report, as well as the market kind of selling off due to some earnings, I think will indicate that we will have rate cuts starting in September. I don't think they'll do an emergency rate cut. I think maybe they should, but that's they're better. They're more focused on forecasting and keeping everybody from freaking out. An emergency, an out of cycle rate cut, even of 0.25% would probably spook the market significantly. But just realize, we talked about this a bit yesterday. If they start cutting 0.25 point every 6 weeks, after 6 months, it takes 6 months to get that full point, right? So even if they get on it, they're going to be late, in my opinion, now. So we'll see what they do. Maybe that first rate cut is 50 basis points or 0.5%. That would, again, that'd probably, I don't see Powell doing that, because I think that would probably spook everybody right before the election. But we shall know more as things start to play out. But obviously, you're going to see your portfolio shrink a little bit, except for very few out there are going up today. The most defensive of all defensive are going up today, but the rest, big tech is taking a hit. So don't get too depressed. Roll back where you were in January. We made a lot of money coming in here, but yes, we're going to give a little back during this session. All right, I'm gonna stop sharing for a minute and just talk about the last two topics. First of all, a CPA. Should you use a CPA? Well, that's a personal decision. I still do all my own taxes, and it is painful. I would not, but honestly, I would not do it, except for the fact that I kind of need to stay up on the tax code. Because tax strategy is a main part of our services that we offer. Is not only making you money, but how to do it as efficient as possible as far as taxes. Well, by doing my own taxes, that allows me to stay on top of the tax code and actually in operation, that sort of thing. Your situation, you may enjoy it, you may not. If you don't, certainly you're paying. CPAs don't work for free, so you're going to pay for that service. But it's another professional you put on your team. And as you move up, I would say in the net worth chain, if you have a CPA, a wealth manager, and a state lawyer all talking to each other, we're using the same three people. There's a lot of synergy there that we can kind of optimize the game plan for you. So instead of just tax reaction, we have true tax strategy in place. So if I come up with this tax strategy for you, the client, then you have to communicate it to the CPA. But if I know who you're using, I can go direct to the CPA. Right, to make sure that you're taken care of. So if you would like a CPA referral, again, you're going to pay to add this person to your team. But I do have a CPA that I like very much. I'm very impressed with. I've already sent a couple of folks there. So that's, if you would like that, have to reach out. I will put that in the email as well. And then lastly, the estate lawyer. This is something that you can kind of speed and get away with it till you're like 40 or so, with in either not having a will or only having some basic will and other protections in place. Once you get to a little bit older, net worth starts getting a little higher, or you have a family situation that might, should something happen out of the clear blue, cause some folks to derail their lives, such as if you have over $1 million and an only child, and your only child isn't that great with money, or is having troubles adjusting to adulthood or something like that, then maybe you don't need to just pour 7 figures of money on that 21-year-old overnight, right? So anyhow, there's reasons to put these basic protections in place. Take care of you, your family, and wealth. Trust will help you avoid probate in a lot of cases. And again, it's private versus public. So if you're thinking about all this stuff, certainly talk with your Ankerstar wealth advisor first, and we'll point you in one or two directions based off of our opinion of what you would like. Again, wills will go basically one direction. Trusts will go to another individual. Both are superstars. They just have very different views on things. I used to be kind of a will only guy. I'm starting to learn more about trusts and get the true understanding of what they offer. So I'm leaning towards that direction. But again, we're just kind of getting started with these the two relationships. And again, with the building coming soon, we'd like to have these folks in-house that we'll see, right? I mean, a lot of things have to happen for that to happen. But again, 2025, we should be able to have folks that maybe are under the same roof, that we can all meet right there in the building, once a year to get on the same page, that sort of thing. So again, if you want a state lawyer referral, let me know what you're thinking, and I can send you to one of the two folks that I trust. All right, that's all I've got for today. Yeah, it's going to look ugly in the markets. I do not see that changing throughout the day, and we'll see how things go on into the next week. But hey, get out there, enjoy life, enjoy the summer, and we will see you guys next week. Bye.